When we talk about credit, I think it's important to remember it's one piece of the big financial picture. Credit oftentimes is seen as, I don't know, daunting, I guess, to some folks. And what happens is, as a young adult, you are given this thing called a credit score, and no one really tells you about it until it happens, and then it matters, and you're like, what? So today I just want to give you guys some basic tools. We're going to look at what overall impacts credit and how, if you are struggling with your credit, you can improve that or maintain a good credit score. So it's one element of credit decision-making processes. So I obviously work for Virginia Credit Union. If you came to Virginia Credit Union for a loan, for a car loan, for a mortgage, we're going to look at your income, and then we're also going to pull your credit. The credit is a way for lenders to decide whether or not what your risk level is. And keep in mind, it was created by lenders, not consumers. So it's not a model that is consumer friendly per se, and there are things that can help your credit that make absolutely no sense to do financially, which we'll talk about as well. So it's really a system, and once you kind of educate yourself on the system, it's a lot easier to navigate through, and also it can help you in the long run save a lot of money. So it's one component to money management, because ultimately it can save you money on those interest rates. If you have really good credit, I am going to end up charging you less for your loans than if you had, rough credit. So the credit scoring in and of itself was created in the 80s to streamline the lending process. And at that point, there were three bureaus, Equifax, Experian, and TransUnion, that started tracking, and they report on how you utilize your credit. It takes at least 6 months for someone to even get a score. So, you might be 18 to 20 and have absolutely no loans or credit cards in your name, thus meaning you probably have absolutely no credit. So what does that mean? We'll talk about it. There's different types of scores out there. Lenders tend to use the FICO score. So I'm going to show you how to pull your credit today. When you pull your credit, you always want to ask for the FICO score versus Vantage or Beacon or other types of models. The FICO is what lenders tend to use, all right? The FICO score ranges from 300 to 850. So as a young adult, when you're starting off with your credit, you're going to start off with absolutely no score. So it's not a negative thing to have no credit. Now, it can impact you on getting loans, which we'll talk about, but it's not going to hinder you from, let's say, employment. A lot of times employers are going to pulling credit to view how people manage money, and it can impact the job interview process as well. So, now all that being said, these three bureaus start tracking you, and they report, and then they score you based upon the different components that they report. And keep in mind, your credit can be continually setting. So for example, each financial entity has like a date where we're going to pull that information and report it to the credit bureaus. Virginia Credit Union's date might be different from Wells Fargo's date, but depending on when or what is being reported, our members' credit would adjust. So that is why you could see your credit adjust all the time, especially every month, depending on what is being reported on your credit. So these are the differences between the Vantage score versus the FICO score. Again, today we are going to focus on our FICO score and what are the components of that, because that is what the lenders tend to use. The FICO score is the oldest and most widely used, and it uses only the information found on the credit report. So the minimum requirements to have a FICO score, we briefly touched on this. It was 6 months or more. So you have to have something being reported about how you manage your credit for at least 6 months, and then you'll be given a score. And it's usually, you probably start off in the 600 range or so once you get started within that 6 months. No indication of deceased on credit report, so, and then one undisputed account reported in the last 6 months. All of these things could be the things that they're looking for you to even start credit. So what are the components that are being reported, and how does that impact your score? Again, it ranges from 300 to 850, and there's cutoffs. So when you go to a lender, they pull your score. Let's say you have a 620. You want at least a 620 when you're looking at mortgages. So if you guys are going, in the market to buy a home, 620 is really a good number to aim for, and even just qualifying for a mortgage, all right? These tiers that you see, 720 to 850, that's considered very good credit. 675 to 719 is considered pretty good. And then fair is your 620 to 674, and then poor is 620 and below. Now, car loans, you could qualify for car loans even with 620 or below. But, keep in mind your interest rate on those car loans are going to be really high if you are underneath that 620 mark. These 5 components are what actually is being tracked and reported to the bureaus. And so we are going to dig into those and see how that can make your score fluctuate, okay? The first one is payment history. So there's 2 ways to kind of look at this. When you think about payment history, there's your bills, so your expenses like your cell phone bill or your rent. Those types of bills are not necessarily reported in a positive light. They might be reported in a negative way, and here's what I mean by that. Your rent, you could pay your rent on time every month for 3 years in a row, and they don't tell the bureaus that you're doing that, and therefore it does not help your credit. You could be late a month or 2 though, and that landlord could report it, and therefore it could hurt your credit. However, things like credit cards, loans, student loans, even if you were to start paying on some of your student loans, that would be reported, and that would actually show in a positive way that you are paying those bills on time. When it comes to credit cards, they do not care if you pay off your credit card. In fact, you can keep a balance on your credit card as far as your payment history goes. Now, financially, is it a smart idea to keep a balance on a credit card? No. But they don't care. As long as you're paying the minimum amount on your credit cards and you're paying it on time consistently every single month, your score can go up if that's reported. All right. Standard loans like car loans, personal loans, mortgages, those things are all reported as well. So you want to make sure that your bills are being paid on time and that you're at least making those minimum payments. Keep in mind, let's say you were late on a bill 5 years ago, and then you were late on a bill last year. Time frame wise, this last year's would weigh more as far as bringing your score down than something that was 5 years ago. Negative items, and we'll go over how long these things would stay on your report, but can stay on there for about 7 years. So you can have something reported, 6 years ago that you were late on a payment or 2, but it's not going to impact you as much as if you were just recently late on those payments. Then they're looking at your ratio as far as what you can borrow and what you have borrowed. So let's say you can borrow $1,000 on your credit card. This is all about what we call capacity. So you have the capacity to borrow $1,000, then you borrow $500. $500's okay, but if you creep that limit on up and you take the full $1,000, that's risky behavior to the lender, and that in return can bring your score down as well. So they want you to utilize your credit cards, they just don't want you to utilize them too much, right? So there's that fine balance. If you are maxed out, in other words, you're taken to the maximum limit on your credit cards, that is going to impact your score in a negative way. And this is 30%. So 35, the biggest piece is that payment history, and then you're looking at your capacity, what that is on your cards. Also, this lends itself to keeping cards open. So when you close out credit with a credit card company, you're actually lowering your capacity to borrow, and that can impact your credit score in a negative way as well. Then leave the credit history. Yeah.
So when you say like 35%, 30%,
Yes.
do they have a chart somewhere that says, well, you know?
No. And like this is what's out there, like general information that the bureaus give out, but there isn't like you're this many points if you do this and this and this, because it's a very fluid model, and it's very individualized too on what is on the report and what's actually, what's happening. So yes.
So you mentioned earlier that by closing a credit card, it can also lower your credit.
Yes.
How substantial, and is it like, I'm sure it's a case-by-case basis, but what is it?
Yeah, so for example, I've had a credit card since I was 19, and I keep it open and use it. If I were to close that out, that could probably hurt me, even like to one tier point. One number could drop you down to the next level, So it is that careful, but because it's such a long, extended history with that company, that would impact me more than if I just opened up an account last year and closed that out.
So long-term credit cards are worse to close than short-term.
Yes. Okay. Good questions. Other questions? I know this is such stimulating, exciting information, isn't it? However, it really does impact you, and over time, it can save you thousands of dollars. So, and again, length of credit history goes back to what we talked about, capacity as well. So you're lowering, if you close out cards, you're lowering your capacity to borrow, and then you're also kind of closing out that history with a company. So this is where, let's say you never get a loan, you never get a credit card, all through school, you walk away debt-free, which would be fabulous, right? And then you get your dream job and you want to buy a house. The house costs $200,000. You don't have $200,000, so you get a mortgage. You need a mortgage. However, am I going to loan you $200,000 if you have absolutely no credit? I'm not. So the catch-22 is people don't want to go into debt because going into debt is bad, right? Because you're owing somebody and they're charging you. But you almost have to go into a little bit of debt in order to start building a history to buy those big ticket items like a home or a car. Get a credit. If you get, I'm not telling you to get a credit card, I'm just showing you how the system works. But if you get a credit card, buy gas on it and then pay it off every month. After 6-7 months, if you've done that in a positive way, you're going to get on the board. It's going to start you and you'll start building that credit. All right, it's just about using that credit wisely. So when the time comes that you want to buy a house or you want to buy a car, you have set yourself up to get the best interest rate at that point in time. So start thinking about developing that credit history. If you are in school right now and you have no desire to get a loan for a car or a house anytime soon, well, my advice is just don't mess up your credit. That's the main thing. You don't want to randomly take out a credit card and just not pay it on time. That happens a lot to young adults that I work with, and they don't realize the implications and how that one choice of taking out a credit card and not paying it on time is going to impact them for many, many years to come. All right, then they're looking at types of credit use. So they're looking at, do you have a car loan, a home loan, student loan, a mortgage? So what are the different types of loans that you have? And then lastly, they're looking at inquiries. So there are things, what we call hard hits on credit and soft hits. every time you actually apply for credit, it will bring your score down a little bit, okay? So you don't want to go to a bunch of department stores and apply for credit, like 3 different stores at the mall in a day. That would be 3 hits on your account, and that would bring your score down 3 times in one day. So that's pretty dangerous to do. Now, you can spread it out every 3 to 6 months and apply for different credit. If you are shopping for big ticket items like homes, cars, student loans as well, you have a time frame of around 30 days and the system's coded. So let's say you are shopping for a new car and you want to get the best rate. So you pull your credit, you get a pre-approval or pre-qualification from your credit union or your bank, then you go to a dealer, they pull your credit, you go to another dealer, they pull your credit. All of those things would count as one hit within like that 30-day span, because they want consumers to be able to shop around for the best rates. You just don't want to apply for a car loan and then a mortgage, because those 2 would be 2 distinctive hits, okay? If you pull your own credit, it does not hurt your score. If an employer pulls your credit, it does not hurt your score. So I would encourage you to pull your credit. Has anybody pulled their credit in here recently? Okay. So yeah, that's great. Most of you have. Especially any type of big transition you might go through. If you're taking on more debt, or you're going through a divorce, or even getting married, talking through all of those things is very important as you proceed in like making your financial goals, because you want to be on the same page. So 10% is that new credit. And here's an example of how it can impact you as far as what your interest rate might be. Now keep in mind, interest rates are extremely low, and if you have good credit at Virginia Credit Union, you can get a great car loan rate of, even less than this, like a 1.7, 1.8, I think is the lowest interest rate. There's stipulations to that loan, but it's a really good rate. So this is just an example. So let's say you wanted to borrow $25,000 for a car, a new car, and you have 5 years to pay it off. If you are up here on this particular tier, this is what you're looking at for your monthly payment, and that might be your interest rate. Now, if you're down here, I mean, like, ooh, I don't think I'm going to give you a loan. And if I do give you a loan, I'm going to charge you a bunch of money for that loan. And so 19.5%, you're looking at $656 a month versus $460. Think about a $200,000 loan. How much money potentially you could save over 30 years. It's thousands and thousands of dollars. So especially, I always counsel, if you're getting ready to buy a house, 6 months before you even start looking, going through that process, you want to pull your credit. And you want to pull it from all 3 of the bureaus. Keep in mind, things that are reported to each of the bureaus could vary. So your credit score could vary. It could be different when you pull it from Experian, when you pull it from TransUnion, when you pull it from Equifax, depending on what is reported. So for example, Wells Fargo might only report stuff to Equifax. Or, you have a medical bill, and maybe that was only reported to TransUnion. So the things on there can vary depending on what's reported. So when you buy a mortgage, when you get a mortgage, your lender is going to pull all 3 of the credit bureau's scores. They're going to drop your high, drop your low, and they would go with your middle score there. If you are buying a car, though, they might only pull it from one of the bureaus. So it could differ what you pull before you go in, because they might have pulled it from a different bureau. Or also the information that is relinquished to the credit bureaus might have just been done the night before and impacted your credit. Many times people pull their credit before they go apply for, which is a smart thing, you should, before they go apply for a loan, and it varies. So keep in mind, there's lots of different factors that could impact that particular thing. So how do you improve your credit? if you're looking, and it can be done, it just takes time. The number one thing you want to do is pay on time every single month on all your accounts. So, if you are struggling with managing some of your debt, a great place to start is to pull your credit, because when you pull your credit, it's going to show you how much you owe at each of the credit card companies, what your minimum payment is on those, if you're delinquent. So it's going to give you all of this information so that you can figure out, oh, really the reason my score is so low is because I was late here and here and here. If I start making my payments on time, then I'm good. Or maybe you're maxed out on your credit cards. So let's say you have 2 different credit cards. You have $1,000 limit on each of your credit cards. One of your credit cards you're maxed out at $1,000, the other credit card you owe nothing. So if you're looking to kind of adjust that ratio, you could balance transfer $500 over to the other credit card to where you would be at 50% on both of those cards. So that way you're not maxed out on one of the credit cards. So there's definitely ways to kind of work the system if you are looking for making your score better. It's just looking at your particular items and figuring out maybe how to manipulate certain things here or there to help you get the best increase. But again, it will take time for all of that to go through. Keep your old accounts, avoid maxing out your credit cards. You do want to limit balance transfers. When you do a balance transfer, a lot of times it lends itself to a new credit pull. Okay, so they might actually pull your credit again before you transfer any balances over, which would then be in that category of new credit or hard hits and soft hits that we spoke about. So that's where that balance transfer could be a little tricky. You also want to be aware, if you do balance transfers, a lot of times they fee you just to do a balance transfer, or it's a percentage of whatever you're transferring that they might charge you, the cost of that. Virginia Credit Union, we have balance transfers that don't do that, but those are just things you want to keep in mind if you are looking to balance transfer. Now, I don't know if you guys have seen like credit repair signs or companies out there, and they're like, oh, we can repair your credit. Okay, so a lot of those companies, you can do everything that they're doing and not pay them $250, okay? When you go, let's say you pull your credit and you decide to dispute an item on there. In other words, there's something on there that you don't think is legitimate. So you write in, you call in, you dispute that item, and then what happens is the credit bureaus take off that item while it's in dispute. So what happens to your score if a negative item's pulled off for a certain amount of time? It's automatically going to go up. So they're saying, oh, we can improve your credit in 30 days. Well, what they're doing is going in and disputing all of these items. And while they're in dispute, they're going to be pulled off. Your score is going to go up. But if those things are legitimate, guess what? They're going back on at the end of the day. So they're working the system. You can go in and dispute those items yourself and go through that process. So when you pull your credit report, on your credit report, whatever is listed always has an owner of it. So whether it's the company that you owe or they sold that maybe to a collection agency, the owner of that debt is information, the phone number, the address should be there. And then you can contact them. You also want to make sure if you're going to repair things and you're going through that process and it, let's say, does get fixed or you start making those payments on a negative item, that it is going to also then be reported to the credit bureaus. So your credit looks better and can go up. Sometimes things can be fixed, let's say a dispute or whatnot, you can start paying on it, and then they never report it to the bureaus. And then, it doesn't even matter then. So you just want to stay on top of it if you're going through that process. So rapid rescoring is not credit repair. It's a fee-based service by lenders to accelerate the dispute process. We have credit counseling through Virginia Credit Union, and it's free to our members. It's called Balance, which I'll show you that information as well. So if you get into trouble and you really need to go through that process and have somebody walk through it with you, Virginia Credit Union does have somebody to do that. So when do you ignore your score? You know, a lot of times people are like, oh, my score. But I mean, there's a time to worry about your score and a time to not. The biggest thing is just don't mess it up. That's what I would say. Just be smart about it. If your score is already excellent, you know, you're in the 720s, and you're feeling pretty good about things, just maintain. And then if you get to the point where you're getting ready to buy that mortgage, to get the mortgage or the car loan, you know, pull it, kind of see where you are, see if, you know, maybe you could get up to 780 by doing a few things. But if it's already good, you just don't want to mess it up. If you're not really using it, my main thing about not really using it, and I've counseled widows that the spouse took care of everything, and then she was left behind, and she had absolutely no credit in her name. And so she had a really hard time, you know, adjusting to that and figuring out, oh, well, do I need to get a credit card? What, you know, what is that process? So that is something you just want to consider, because if somebody else is taking care of the finances and has all of the credit in their name, what happens if that relationship does go away? You want to just be smart about your own, because your individual credit is your credit. Your spouse's credit is their credit. Now, what happens, like, if you have joint accounts, like joint loans with somebody else, their actions could impact your score, but their score is not your score, all right? Or you have more important financial issues to deal with. You just want to be cognizant about it and make sure you're making those right choices. Sometimes if you don't have a particular FICO score, they might use what we call a FICO expansion score. And this is data collected from like landlords, utilities, etc. Bankruptcy risk score, a lot of financial institutions use this as an overall view of whether or not to lend somebody money. So they're looking at what is the likelihood of this person going bankrupt. So they're looking at your income, looking at your credit, they're looking at the overall financial picture to decide whether or not to give you a loan or pre-approval for something. So this is the website, annualcreditreport.com. It's like the government-endorsed website to pull your credit. You can pull your credit from all 3 bureaus at this one website. It is not going to give you your score for free. It will give you your credit report, but not your score. If you want your score, I think it costs around $13, $14 from each of the bureaus. So if you're just wanting to see what's on there, just go on there and pull it. Now, if you're getting ready to buy a house, I would definitely go ahead and pay for those 3 scores to see where you are. Some people like to spread these out. So let's say you pull your report from Equifax in January, pull your report from Experian in July, and then December TransUnion. So, you know, throughout the year, you're continually pulling it just to make sure everything's on the up and up. If you ever get your identity stolen, this is absolutely the first thing that you need to do is pull your credit. And I would actually do monitoring on those credit reports, which you can do if you're a victim of identity theft. So what is on the credit report? A lot of times things will be outdated that's on there when you pull it, and you can contact the credit bureaus and update that information if you want to, but I'm talking about like jobs. A lot of times your job is not on your credit or what it is, and it might be on there, but it might be an old job that you've had, so that would be up to you. But making sure the social security number, date of birth is all correct, that's very important, because you know, if your dad's a senior and you're a junior and you have the same name, sometimes we've seen it where that person's credit gets intertwined with yours. Creditors, payment history, bankruptcies, inquiries, etc. Here is like timeframes of what is on your report and how long it stays on there. 2 years, so every time you apply for credit, that actually will show up on your report. Even if you get pre-approvals, so you get pre-approvals in the mail, right? Oh, you're pre-approved for this credit card or car loan or whatnot. They have what we call soft hit your credit, and that will show up as well. Now, it doesn't hurt your credit score, but the very last, like the last line item on your credit report are those soft inquiries. So it'll show different financial institutions out there that might have soft hit your credit. But those inquiries will stay on your report for 2 years. And then negative items will stay on there for up to 7 years. This includes bankruptcies. Chapter 13 is 7 years. Chapter 7 is 10 years, because the severity of a Chapter 7 bankruptcy is more so it's on there longer. But the Chapter 13 will roll off after 7 years. Now, if you have a negative item on your credit report, on there, it also will have a date attached. So that date attached will show you when it was initially reported, and then that 7 years from that time frame would be when it would roll off. Some reports do it differently depending on which one you pull. Some will have the date of when it is going to roll off. So you just want to be aware of that. So that's something you want to keep in mind when you're disputing things as well. If they're getting ready, something happened 6 years ago, and it's getting ready just to roll off your credit the next year or so, I don't know, maybe leave it alone. So it's you want to look at the overall picture there as well, and how it's impacting you, and what your goal is at the end of the day. So, credit scoring was developed to maintain objectivity and fairness. I don't know. I mean, if it does that, for sure. There are wonderful, awesome people out there with bad credit, right? And then a lot of times, people with bad credit are really the folks that cannot afford to pay more for loans or things like that. So the system is a little messed up, if you ask me. And it's really about education and understanding all of those different components, because I think if most people did really understand those things, they wouldn't make the choices that they do. You have the power to create a good score and concentrate on the category of scoring that is weighed the heaviest, so paying your bills on time, and then having a good capacity ratio there, not maxing out your credit cards. Those two things are the biggest piece of the pie, right? This is the service that Virginia Credit Union offers if you are a member. It's a phone counseling service where you can pull your credit and they will go over it with you and look at your different options if you are struggling with your score, or you have particular goals for your finances. That, let's say in a year you want to buy a house and you want to have a 780 credit score. How do I do that? So they can take a look at your report and kind of help you and guide you through the best scenario of what to do to improve your credit. They can also go and dispute things for you, things like that, walk you through the process. Okay? The question was, how do student loans impact your credit or getting a mortgage? They do. So student loans, if you are in school right now, they are in deferment, right? You're not having to pay on your student loans. So it's not a negative thing on there as far as like you're late or anything like that. Your student loans will be on your credit report when you pull them. And in fact, depending on subsidized, unsubsidized, I've seen multiple student loans on folks' credit report. Of course, then once you graduate, you consolidate all of those loans through the direct consolidation program, where you have that one payment and one interest rate to worry about. You can make payments on your student loans while you're in school, and it will show up on your report that you made that payment, and that would lend itself to payment history and could help raise your score, all right? If it's just on there and it's in deferment, it's not hurting you necessarily, but it's not helping you either, okay? Now, how does it impact mortgages? it's going to reduce the amount that you can borrow at the end of the day, because it's going to be seen as debt against you. So maybe you could have afforded a $300,000 house without the student loan, but with the student loan, you can afford maybe a $250,000 house because you've got that debt. But they're going to look at your monthly payment. So it's all about the monthly payments, not the overall debt, but what you owe each month toward that debt. So when they're figuring out how much of a house you can afford, they're looking at what is your minimum monthly payment for your credit card, for your car payment, for your student loan, and then at the end of the day, if we add on more debt to that, how much can you afford based upon your income? Does that make sense? So the question was, if you get the opportunity to up your limit on your credit cards, should you? I mean, it's fine to do. The main thing is, it's worse if it goes down. And a lot of times credit card companies, if you don't utilize your credit card, will make your limit go down. And so if you already have a balance on there and your limit goes down, you could be at the top of your max. You could almost be maxing it out. Okay, so let's say you originally had a $5,000 balance. You charged $2,000 on there, and they decided to lower your limit to $3,000. So you are nearing that top tier of maxing out your card. So, however, if they give you more credit, that's going to open up that capacity more to borrow. So that, in return, at the end of the day, could maybe increase it depending on how much you already have on there. Now, if you're just not using your credit card ever, and they offer to up your limit, the only thing I would say would impact it is if they pulled your credit score to figure out whether or not to give you more of a limit, because that would impact it as a hit on your credit. So that is going to be a negative thing on your report, and it would impact your score a lot because it's payment history, and that's the biggest piece of it. So if you start paying down debt through that collection agency, that's what I was saying. You want to make sure that that is being reported and that the collection agency is showing that you have negotiated that and that you're paying that down. So, yeah. But that would be on there then for that 7-year span. So it's going to be on your report for 7 years.